What's up, YouTube? It's the Action Figure Grader coming back to you with another video. And as promised in an earlier video, I wanted to take a look at some more recent economic data for the US specifically. And as it ties into the collectibles market, and I get so many questions every week, every day, saying, why is the market going so crazy? These prices are nuts for both vintage and for modern Star Wars items. And the biggest driver obviously is demand. Collectors are demanding a lot of Star Wars related items, so prices are going up. But I think tied into that is what the U.S. economy is doing on a macroeconomic level, and the inflation we're seeing. As I've talked about in previous videos, inflation's pretty high right now. Prices are soaring for everything, from commodities to houses to the stock market to just everyday groceries and gas. So I think that ties in to what's causing some, not all, obviously, of the price increases that we're seeing in the collectibles market. And I put together some recent articles. Some of them date back to May, but most of it's fairly current within the last week or so as new economic data has come out. So I wanted to kind of show you just some really interesting information. And I'm not sure if we'll ever see these kind of numbers in our lifetimes ever again, unless we have another traumatic event like we had last year, or some other kind of major war or something like that. But the numbers are pretty eye-popping. So I'm going to go through a series of articles and just kind of give you my thoughts on them. And some of you might find it interesting, some of you may not, but I just thought it was interesting enough for me that I wanted to share it with you. So one of the more interesting articles that came out, well, this was July 1st, and it talks about the Fed's Reverse Repo program and how it saw a massive soar in demand for that. And what is the repo program? Well, that program basically is a place to store short-term cash, whether it's banks, whether it's money market funds, individuals with big cash balances through their bank. The federal government the Federal Reserve, not the federal government, the Federal Reserve offers a place for banks and for money market funds and different mutual funds to store short-term cash. And that surged to a record $991 billion. That is a massive number, almost $1 trillion of just cash. And historically, at least the short-term history for this program, it was at a 0% interest rate. They did not offer you any kind of interest on your cash. And so this goes back to what I was talking about. As inflation increases, your money is becoming worth less and less. Well, in mid-June, the Federal Reserve increased, quote unquote, the interest rate from 0% to 0.05%. So not a big jump, but it was enough to take the typical demand from about $755 billion of short-term cash to almost $1 trillion. So, and what that is, basically, I'm going to highlight this section here. Essentially, the Fed is keen to reduce cash balances in the banking system to avoid the overnight banking rate going negative. So what does that mean? So banks can lend money to other banks who do not meet their Federal Reserve requirements for cash balances. And it's called an overnight rate that they charge at it. And they were worried about it going negative. So what does that mean? That means that if you have cash, you would have to pay somebody else to take it off your hands. Think about that and how crazy that is. You would not get any interest on it. You would actually pay somebody if the rate had gone negative. And so because there's so much cash in the system right now due to all these stimulus bills and all this cash that's overwhelming the U.S. money market funds, the Fed stepped in and said, we'll give you 0.05% interest on that. And that was enough to send it to $1 trillion. And right now, U.S. money market funds, just U.S. money market funds, not including banks, they have over $4 trillion in cash right now. There is just an excess of cash in the market right now. And that's been driven by, a number of factors, including stimulus bills, what the Fed's been doing with buying mortgages to kind of keep rates low so houses continued their upward climb in prices. But that to me is pretty amazing that they were worried about the overnight lending rate going negative. And it's just a sign that there's just so much cash out there. And, on a collecting basis, let's reel it back into the collecting world. How does that affect you as an individual? Well, there's a lot of, what's that mean is that there's a lot of individuals out there that have hordes of cash, hordes of it. and they're parking it in collectibles to a certain extent. Certainly not their entire cash balance, but if they have cash and they're worried about inflation, they're going to put it in hard assets, like I've talked about before. And part of their allocation apparently is going to be in collectibles, just given what prices have done. So just an incredible statistic there that I'm not sure if we'll ever see that again in our lifetime. Inflation spikes in May. So let's go back to May real quick before I tell you about June. But inflation measurements, as I've talked about, it raised in May to an annual rate of 5%, which is the highest number that they've seen since August of 2008. So let's call it 14, 15 years. That's the highest monthly rise we've seen in prices. And I'm gonna show you a really funny, in my opinion, really funny tweet that the White House Twitter account sent out for July 4th a little bit later on in this video to show you how ridiculous the mindset is of all politicians. I'm not picking a side here. All politicians are completely insane, and they're not in touch with the reality that Americans are facing right now with inflation. But so that was a big number, and the core inflation, which excludes food and energy, which are highly volatile numbers, that still rose 3.8%, which was the highest increase since June of 1992. So that was what's that 02, 12. So in 29 years, almost 30 years, the inflation rate in May jumped the highest in 30 years. I mean, that's just unbelievable, and just a sign of just how much demand has been pent up due to the events of last year. We're playing catch up right now, and it's just insane. So that was May. Now let's look at June. June's numbers just came out on July 2nd, so just a few days ago, and the June numbers where the inflation rose 3.1%, so another massive jump. And again, if you look at the largest changes in the index, they were petroleum products, which you would expect. Gas is much higher demand. We're right in the heart of the summer season, so U.S. consumers are out on vacations, are taking road trips, so you would expect that number to go up. Electricity, you would also expect to go up, just given the heat waves we've had here in the U.S. So those were the two biggest changes. Transportation, housing, water, all of those numbers are going up. Clothing, and so anyway, it's just back-to-back months now of just massive inflation numbers. And recently this article came out, let's see, July 1st. So the CBO, which is the Congressional Budget Office, so basically an arm of the government, they're basically saying that they see a supercharged recovery, big surprise there, and they predict severe inflation in the coming months. Well, big surprise. That's not exactly Nostradamus level predictions here, since we're already seeing that stuff. But the interesting thing is that they're saying that the CBO, which is a branch of the government, they're expecting inflation to actually fall off after a short-term blip, and that's what the market is also predicting. So, the stock market and the bond market, what are they? So basically, they are trying to predict what what a certain stock or a certain financial instrument is going to do. That's really all a stock is. A stock price is basically a forecast of what those earnings are in the future, and you take the present value of that in theory, and that's what the stock price is. Well, if you look at the 10-year Treasury rates, and they dipped recently. This article came out June 30th. The 10-year Treasury rate dipped below 1.5%. And what they're basically saying is a key market signal is predicting that this inflation is going to be short term. And I don't know if that's the case personally. I don't know how that's possible that they only see short term inflation, but the market knows more than I do. I'm not very bright. And the market as a whole is predicting that inflation is just transitory. This is going to be a short 3 to 6 to 9 month kind of window where we're going to see these crazy inflation numbers that we just went over, and that's what the market is saying. Anytime the rate drops, that means that they're expecting they're expecting inflation to not be significant in the long term. This is a 10-year note. And, and this is what it says: the 10-year Treasury is signaling that we are not going to get sustained inflation above 2%. Well, I don't know how that reconciles with what's going on in the market right now. And again, it could be a short-term thing where all this, stocks and real estate and collectibles, they're all going up like crazy, and it's a short-term thing. But in my opinion, based on what the monetary stimulus that we're continuing to pass as a country, they're trying to pass more of it right now. Another 1.8, 1.9 trillion. They're trying to pass another stimulus check to U.S. households. It takes time for that stuff to get through the monetary system. And as we've already talked about, the monetary system right now already has too much cash, yet they're still trying to pass more of that. So I don't know how I don't know how the market can say that. And there's other Wall Street related companies like Bank of America that are predicting totally different numbers than that. And we'll go over that in a second. And then the Fed again came out with another article that's saying inflation will grow faster than projected just 3 months ago. So 3 months ago, the Fed was projecting one thing. 3 months later, based on all this data that's coming out for May and June, they're saying that inflation is going to be even higher. So this to me is kind of more in line with reality. And it's almost like every week as these economic metrics come out, the CPI index that covers inflation, the unemployment numbers, how many new jobs are added, what gas prices and the stock market's doing. I don't know. It just seems like they're not quite. The Fed doesn't have a really good idea of what the market's really going to do, but it seems like they're starting to hint that they're going to have to raise the federal funds rate, which in turn affects all of the economic lending that goes on with banks. And that tends to, as the Fed raises that federal funds rate, that drops demand for new loans because it gets more expensive. And it seems like they're starting to hint that they're going to have an interest rate hike sooner rather than later. And just in March, they predicted inflation was going to be 2.4%. Now they're saying 3.4%. And back in March, they were saying they weren't projecting to raise rates until 2024. Now they're saying it's going to be a lot sooner than that. So me personally, I kind of hope they do that, because it just seems like all of the data that we're seeing, not only on houses and stuff like that, but in the collectibles market, it just seems like we're already overheated right now, and we're overdue, in my opinion, to have some sort of brake pedal be applied towards the economy. And so you see all that data and how it's starting to shift towards inflation going from being transitory to now it's going to be even higher than expected while still transitory. That's the government side. But now let's talk about corporations and Wall Street and what they're expecting. And Bank of America just came out with an article on June 25th where they think inflation is going to be elevated for the next 4 years. So who knows if they're right, but that seems more in reality to me, is that everything that's going on right now, it just takes time for all that money to kind of get pushed through the system and get reinvested, in corporations and in loans and in expansion and current businesses. And we're already seeing that with all the different grading companies. They're all expanding and they're all moving to bigger facilities. They're all seeing unprecedented demand in new submissions. So they have to hire more people, and all that stuff takes time. And so, Bank of America has come out saying, we don't see this as transitory at all. This inflation that we're seeing right now, we're seeing it's going to be here for another 4 years. So that was a really interesting prediction. And again, who knows if they're right? They've been wrong on a lot of stuff. Wall Street is I never want to bet against Wall Street, but they have been wrong on a lot of different things. A lot of Wall Street analysts called for a pullback in stocks, a pullback in the real estate market for a year now, and it still hasn't happened yet. And I think they underestimated the effects that all of these monetary stimulus policies that the government is passing, all of the manipulation that the Federal Reserve is doing to keep rates low. I think they underestimated how that would really play out in the market. And so B of A, they said inflation will remain in the 2 to 4% range over the next 2 to 4 years. U.S. inflation has averaged 3% in the last 100 years, 2% in the 2010s, and 1% in 2020, which you would expect that in 2020, given everything that happened. Prices deflated, they dropped through the floor. because everyone was staying home and not spending money. But now they're saying it has been an 8% so far in 2021, an annualized inflation rate of 8% in 2021. And in my opinion, that number is even probably low. I think we're probably in the double-digit inflation numbers right now. And circling back to the collectibles market, that's pretty well supported, I would say. I think any of you that watch my market updates for not only the vintage collection but vintage Kenner items, we've seen way higher than 8%, 8 to 10% price rises in just the collectibles market. In real estate, where I do business, the median house sale in the entire U.S. is up 24% versus last year. Think about that. Your money, if you had bought a house last year versus now, you're getting 24% less house than you were a year ago. That is mind-blowing to me, and easily the largest number I've seen in 17 years of doing real estate. So that is just a crazy number to think about. And so I think that this number is probably closer to reality versus what the CBO and the White House and even the Federal Reserve is predicting in terms of inflation. I want to show you really quickly a really funny tweet that the White House sent out on July 4th. They said, our policies are working. The average cost of a bundle of meal items that was hand-selected and cherry-picked, by the way, is down 16 cents versus last year. They're bragging about a 16-cent difference in the price of a meal for July 4th versus last year. That was hand-picked and cherry-picked in terms of the items, by the way. So that's what they're bragging about. Meanwhile, everything else is up between 8 and 10% in prices or more. Real estate's up. You're getting 24% less house, but your processed, pig gut hot dogs are 16 cents less. Congratulations, White House. Great job. I just thought that was hilarious. And they were universally mocked across Twitter. And I just, that's so completely out of touch with what the American people are dealing with right now. And just really, whoever sent that tweet probably needs to reel that one back in. That was a really bad idea. One other quick point that this article was on CNBC. Inflation is the silent killer as retirees are feeling the sting. And I think this is a really good point as it relates to inflation. Retirees in general, they've retired. They don't have any income in terms of earnings. And so they're living off of fixed income items like Social Security, like pensions, and whatever kind of income they're receiving from their stocks and bonds, things like that. And an interesting thing is that as inflation jumps through the roof, their buying power is decreasing. And one way that retirees are trying to stave off inflation is by changing their stock portfolio allocations. So retirees tend to have less risk because they're towards the end of their life. They want to keep it in fairly stable assets like fixed income securities and bonds and things like that. But because of inflation, they're taking those low risk assets and they're putting it into things like stocks that are jumping through the roof to try and stave off inflation and their lack of purchasing power as it decreases with inflation. So if I'm a retiree and I've got, let's say, $500,000 in assets, if 400,000 of that was in safe bonds, I might reallocate that to stocks because of stocks jumping like they are, to try and improve the amount of money that I'm going to have to work with each year to pay for my living expenses. So again, it's just another interesting point that might be tied, to a certain. We have a lot of retirees in the U.S. The U.S. population is aging. Technology's improved. Medical things have improved to increase the length of life for U.S. citizens, right? And so because of that, they need more money to live on retirement, or they got to work longer, later in life. The average retirement, 20, 30 years ago was probably in the low 60s, 65-ish. A lot of people are saying people are going to start retiring at 70 and 75 because they just don't have enough money as their life expectancy increases. So it's just another interesting fact that I think is also a big driver for what, the stock market is doing right now in the US. And finally, before I wrap this video up, in June, the US economy gained 850,000 jobs. That's a big number, as you can see in this chart. It's still nowhere near some of the other levels that we saw right as we opened back up as an economy. But the interesting part, I think, about the U.S. employment numbers is that the unemployment rate actually went up briefly, or went up for June. And there's still a lot of people that are sitting on the sidelines in those states that are high population, by the way, receiving these stimulus benefits and these unemployment benefits. And the other interesting aspect I want to point out as it relates to unemployment is that those states that got rid of the federal unemployment benefits and saying, hey, you guys need to get back to work, we're not giving you these free rides anymore, those states have seen a massive boom in their economies because people are saying, I need to get back to work, I'm not getting all this free money anymore. And those states that did not and are still relying on these federal kind of bump up checks, those economies are doing much more poorly. So it's something to think about. And I think that's why you're seeing a lot of people in those states that are not opening back up their economy as rapidly as some other states, such as in the South and Southeast. A lot of those population bases are moving to those other states. And I'm seeing that here in Nashville. I'm seeing this influx of people who have sold their properties in high tax states and where there's still these kind of like mid-tier lockdown type situations. And they're like, I'm done with this. I want to go back to opening it up. I want to get back to work. And we're seeing massive influxes of money. And that's the other big driver for real estate prices, at least here locally. So anyway, I thought that it was important to kind of show you even more updated kind of employment and economic data and inflation measures, because while it's not as big of a factor as demand for collectibles are, these types of measurements still show why prices are increasing for everything, not just collectibles, but everything. And I just thought it was really interesting information, and I hope you found it interesting. If you're new to the channel, welcome. Thank you for watching. And for those of you who are existing subscribers, I want to thank you for watching again. I'll be back soon with some TVC market update, a TVC market update later this week, as well as a vintage Kenner update. Thank you again for watching, and I'll be back soon.